Hey everyone, welcome back to the channel. If you're new here, hit that subscribe button and turn on notifications so you never miss our weekly market breakdowns. This week we're diving into stocks that are setting up for major moves: PayPal, Enphase Energy, Chewy, UiPath, Corsair Gaming, and UPS. We've got earnings catalysts, technical setups, and key levels you need to watch as we head into the trading week starting Monday, February 9th. But before we jump into the individual stocks, let's talk about the macro picture. What's happening with the economy this week and which major earnings reports could move the entire market? Let's get into it. All right, let's set the stage for this week. We have some significant economic data drops and a stacked earnings calendar that could create serious volatility. Starting with the economic calendar, on Wednesday, February 11th at 8:30 a.m. Eastern, we get the January employment report, jobs data that will tell us whether the labor market is staying resilient or starting to crack. The Fed is watching this closely as they navigate their policy path. Then the big one, Friday, February 13th at 8:30 a.m., the January CPI report drops. Consensus is calling for inflation to hold steady around 2.7% year over year, unchanged from December. But here's the thing. If we get an upside surprise, expect rate cut expectations to get pushed out even further, which could pressure growth stocks. Core CPI is expected at 2.6%, the lowest since 2021. This is a market-moving event, so be prepared for whipsaw action into the close on Friday. We also get wholesale inventories on Monday and the employment cost index on Tuesday, both giving us clues about inflation pressures and business sentiment. Now, on to earnings. This is where it gets really interesting. This week is loaded with high-profile names. Monday, February 9th, we've got Cleveland Cliffs, Becton Dickinson, and Monday.com reporting before the bell. Or Tuesday, February 10th, we get Coca-Cola, C5S, Oscar Ford, Cloudflare, and Robinhood. Hood's been volatile, and this could be a big mover. Wednesday, February 11th, we see Shopify, Unity, Humana, Kraft Heinz, T-Mobile, and McDonald's, Cisco, and QuantumScape. Shopify's e-commerce health will give us a read on consumer spending, and Cisco's enterprise demand will signal corporate IT budgets. Thursday, February 12th, Coinbase reports analysts expect flat revenue around $1.86 billion, but a 50% profit decline with EPs falling to about $1. Crypto sentiment has been mixed, so this could swing either way. We also get Pinterest, Roku, and DraftKings on Thursday. Friday, February 13th, earnings wind down with smaller names, but don't sleep on it. CPI data will dominate sentiment. Bottom line, between jobs data, inflation numbers, and a parade of high beta tech and fintech earnings, this week is going to be action-packed. Volatility is your friend if you're positioned correctly. Now let's break down our 6 watch list names, starting with the most dramatic setup of the week. First up, PayPal. This one is a battlefield right now. PayPal is trading around $40, down over 20% in just the past week. The stock absolutely crashed after reporting fourth quarter 2025 earnings and weak 2026 profit guidance. To make things worse, they announced an abrupt CEO change. Enrique Lores is taking over, and that spooked the market even more. Investors are worried about execution risk and whether the turnaround story is real or just hope. Right now, the stock is trading near 7 to 8 times forward earnings with a 14-day RSI that recently hit 13. That's deep oversold territory. The 50-day moving average is up near $58, and the 200-day is around $65, which tells you how violent this sell-off has been. The bull case is that PayPal is aggressively buying back stock. They're targeting around 15% of their market cap through 2026. They've also initiated a quarterly dividend of 14 cents. Free cash flow remains strong, and at these valuations, if the new CEO can stabilize the business, this could be one of the best risk-reward setups in fintech. Some analysts are calling this a double-digit buyback, turning the crash into an opportunity. The bear case is that branded checkout growth is slow. Competition from Apple Pay, Google Pay, and others is brutal. The 2026 outlook was weak, and we don't know if the new CEO can execute. There's a real risk this becomes a value trap. Support to watch, $38 to $39 is your key zone. If it holds above that early in the week, you've got a potential bounce setup. Resistance, a push back toward 42 to $44 would be the first sign of stabilization. For swing traders, if you believe in the turnaround, you can start scaling in near the lows with tight stops under $38. Size small, this is high risk, high reward. What to watch? Any new commentary from the CEO, analyst upgrades on weakness, or further downgrades that extend the pain. PayPal is definitely not for the faint of heart right now, but for those who can't stomach volatility, this could be a generational entry point or a falling knife. Manage your risk carefully. Next up, Enphase Energy. This one just had a monster move. The situation, Enphase is trading around $50 after ripping nearly 40% higher in one session following earnings. The company reported fourth quarter results that beat lowered expectations, and more importantly, management guided that first quarter 2026 could be the bottom for the solar demand downturn. That was music to the ears of beaten down solar bulls. Revenue came in at better than feared levels despite a year-over-year decline, and guidance for one Guatemalan quetzal is $270 to $300 million. Analysts started upgrading. RBC went to outperform with a $54 target, and BMO lifted to market perform with a $41 target. There's also buzz around new commercial products and bi-directional EV charging, which could be growth drivers in 2026 and beyond. The bull case. If this really is the bottom for solar, Enphase is setting up for a huge recovery. The stock has massive short interest, and we just saw the start of what could be an epic short squeeze. Analysts are talking about a path to $60 if momentum continues. The technical breakout is real, and sentiment is shifting fast. On the other hand, the bear case is that this stock is now overbought. The 14-day RSI recently exited the overbought zone, and after a 40% move in a day, you have to expect some profit taking or consolidation. If macro conditions don't improve or solar policy doesn't materialize as hoped, this could give back a chunk of the gains quickly. Trading plan for the week, current level around $50. This is elevated after the gap up. Pullback zone to watch. If it consolidates or dips back into the mid 40 seconds, that could be your entry for a continuation play. I'd want to see it hold above $40 as the line in the sand. Resistance, low 50 seconds is immediate resistance. A clean break above $52 with volume could target that $60 level analysts are talking about. For position traders, if you already own it, consider trailing stops under recent support, maybe the $45 to $46 area, and let it run. If you're looking to enter, wait for a breather rather than chasing here. Watch for any follow through on solar sentiment, policy news, or a pullback that holds key support levels. Volatility is your friend here, but so is patience. Enphase is a high beta name. If you can handle the swings, this is one of the more exciting setups on the board right now. All right, let's talk about Chewy, the ultimate contrarian play this week. The situation, Chewy is trading around $28, dangerously close to its 52-week low of $26.34. The stock is down about 20% year to date and more than 30% over the past year. Investors are concerned about softening pet ownership trends, discretionary spending pullbacks, and the big overhang from BC Partners, which still owns around 42% of the company. But here's where it gets interesting. The stock is deeply oversold. The 14-day RSI is sitting in the mid-20s to mid-30s, and the MACD recently flipped into a buy zone. The 50-day moving average is in the low 30 and the 200 days in the mid 30, both well above the current price. The bull case, Piper Sandler just reiterated an overweight rating with a $48 target. That's a 70% upside from current levels. They expect management to guide 7 to 8% sales growth for 2026 and see room for the company to beat and raise as the year progresses. Morgan Stanley also highlighted Chewy as having a clearer path to value creation within the internet sector, even amid broader headwinds. If operational leverage improves and customer metrics stabilize, this stock could mean revert hard. The bear case, pet spend is discretionary, and if the economy weakens, this gets hit. The BC Partners overhang is real, and until they reduce their stake, there's a supply cloud over the stock. Guidance expectations are modest, and if they disappoint again, this could break to new lows. Trading plan for the week, support zone $26 to $28 is your battleground. This is where you want to see buyers step in. Entry trigger, look for a reversal candle or intraday higher low in this zone. A clean bounce with volume would signal accumulation. Target, a move back toward the low $30 is the first mean reversion target. That's around a 10% move from current levels. A stop, if it breaks below $26 on a closing basis, the setup is invalidated and you'd want to be out. What to watch? Any positive commentary on customer growth, auto ship retention, or spending resilience. Also watch for volume spikes on up days that would confirm accumulation rather than distribution. Chewy is the definition of hated and oversold. If you're a contrarian and believe in the business fundamentals, this could be a high probability bounce setup into the end of February. Now let's talk about UiPath, a stock that's had a wild ride and just got a fresh catalyst. The situation, Path is trading around $13 after a recent 6 to 7% pop on massive volume. We're talking over 34 million shares traded. The catalyst? UiPath beat earnings expectations with EPS of 16 cents versus the street's 14 cents, and revenue grew about 16% year over year to $411 million. But the bigger story is the acquisition of WorkFusion, a company that specializes in AI agents for financial crime compliance. This deal strengthens UiPath's offering in the banking and financial services sector, which is a huge growth opportunity. Wall Street is still cautious. Consensus is mostly hold, with an average target around $16, though some firms like Barclays and Truist have raised their targets into the high teens. The bull case, the AI and automation story, is intact. UiPath is positioning itself as a leader in agentic AI that can take actions, not just provide insights. The WorkFusion acquisition is strategic, and if they can integrate it well, it opens up massive enterprise demand in financial services. If the stock can reclaim the mid-teens and hold, the next leg higher could target the high teens to $20. The bear case, sentiment is fragile. The stock is still well below its 50-day moving average, which is around $15.60. Analysts are mixed, and there's skepticism about whether growth can reaccelerate. If macro conditions weaken or enterprise spending slows, Path could drift lower again. Trading plan for the week, current level around $13. This is elevated off recent lows, but still below key resistance. Prove it level, a reclaim of $15 on strong volume would be your breakout signal. That's where momentum players will pile in. Range trade, if it chops between $12 and $15, you can buy near the lower end with tight stops and take profits toward the upper band. Stop. A break back below $12 would invalidate the bounce setup. What to watch? Additional details on the WorkFusion integration, any commentary from management on AI agent adoption, and revisions to 2026 estimates. If analysts start raising numbers, that's your signal. This is more than just a dead cat bounce. UiPath is a show me stock right now. It needs to prove it can hold gains and build momentum. But if it does, the upside could be significant. Let's go over Corsair Gaming. I'm going to be blunt. This is a speculative high-risk play. The situation, Corsair is trading around $5.20, with a 52-week range of $4.59 to $13.02. The stock has a beta of 2.45, which means it's extremely volatile. When it moves, it moves. Last quarter, revenue came in around $346 million, up 14% year over year, but it missed estimates slightly. An EPS of 6 cents missed by 2 cents. Net margins are still slightly negative, though ROE is modestly positive. Analyst sentiment is all over the place. Wedbush kept an outperform rating but cut their target from $9 to $7. However, another outlet just upgraded CRSR to buy at these depressed levels, suggesting there's perceived value near $5. The bull case: if gaming hardware demand improves, whether through a new console cycle, PC gaming resurgence, or esports streaming trends, Corsair is leveraged to that upside. At $5, it's near multi-year lows, and any positive surprise could drive a sharp rebound. Some traders are looking at $6 to $7 as first targets if momentum returns. The bear case: fundamentals are weak, profitability is thin, liquidity is a concern. This is a small cap stock with high volatility, and if macro conditions worsen or gaming hardware stays soft, this could drift lower or trade sideways indefinitely. It's very easy to lose money here. Trading plan for the week: support zone $4.60 to $5 is your line in the sand. This is the 52-week low area. Entry: if you're speculative, you can buy near this support with a tight stop under $4.50. Size small. This is a lottery ticket, not a core position. Target $6 to $7 would be your first profit-taking zone if it works. Risk management: do not oversize this trade, except that you could be wrong quickly. What to watch: any news on new product launches, channel inventory normalization, or commentary from gaming, PC peers like Logitech, Nvidia, or AMD that might impact demand expectations. Corsair is not for everyone. If you trade it, treat it like a high-risk, high-reward speculation, nothing more. Finally, let's talk about UPS, the income and value play on this watch list. Here is the situation. UPS is trading in the low minus $100 with an annual dividend of $6.56, giving you a forward yield in the mid-6 range depending on the exact price. The stock is up mid-teens % year to date and roughly high 30s% over the past 6 months, but it's still trading around 15 times forward earnings, which some analysts see as reasonable given the turnaround story. UPS just reaffirmed its $1.64 quarterly dividend and boosted 2026 free cash flow guidance after reporting fourth quarter 2025 results. Revenue came in around $24.5 billion for the quarter, with full year 2025 revenue at about $88.7 billion. For 2026, they're guiding to around $89.7 billion in revenue. Strategy: UPS is cutting low-margin Amazon volumes and focusing on higher-margin international and healthcare logistics. They're investing heavily in automation and cost discipline to drive margin expansion and free cash flow recovery. Management is making it clear they're prioritizing quality revenue over volume revenue. The bull case: the dividend is safe and attractive in this rate environment. Free cash flow guidance is improving. The strategic pivot away from Amazon and toward healthcare and international is the right move long term. Some models suggest 30% upside over a multi-year horizon if execution is solid. For income investors, this is a high-quality yield play with capital appreciation potential. The bear case: the Amazon volume reduction is a headwind in the near term. If the economy slows, shipping volumes could disappoint. Execution risk is real. If margins don't improve as expected, the stock could stall. Trading plan for the week: income approach: any pullback toward the high $90 or low $100 is a zone to add if the free cash flow story and dividend coverage remain intact. Tactical trade: if you're more active, treat the recent breakout level just under current price as support. A hold above that keeps the uptrend valid. A decisive break could be your signal to trim. Covered call strategy: given the yield and moderate volatility, selling short-dated calls slightly out of the money can harvest premium while you collect the dividend. Just be comfortable with potential assignment. What to watch: any macro data on shipping volumes, retailer commentary on logistics, and further updates on Amazon mix and healthcare international growth. UPS is the sleep well at night play on this watch list. It's not going to double overnight, but it offers a solid yield, improving fundamentals, and a clear strategic path forward. All right, that's the breakdown for the week of February 9th. To recap, we've got PayPal, deep value or value trap, trading near $40 with extreme oversold conditions. Enphase, post-earnings moonshot, now consolidating near $50. Chewy, oversold and hated, sitting near 52-week lows with a 70% upside target from Piper Sandler. Path, AI automation story with a fresh acquisition catalyst. Corsair, high risk, high reward speculation near multi-year lows. UPS income and value play with a 6% yield and improving free cash flow. This week is going to be interesting with CPI on Friday, jobs data on Wednesday, and a massive earnings calendar featuring Robinhood, Coinbase, Shopify, and others. Stay disciplined, manage your risk, and don't chase. Let the setups come to you. If you found this breakdown helpful, smash that like button, subscribe if you haven't already, and drop a comment letting me know which stock you're most excited about this week. Thanks for watching, and I'll see you in the next one. Trade safe.